Coffee.
Okay, Tom. So I've heard you on a conversation a few weeks back. You were talking to a guy, and he was asking you about the financial situation in the world and what's your thoughts on it. And you said a statement, and you said, "He who loses the least wins." And I've heard you say this a few times, so I'd like you to elaborate on that.
Yeah, it didn't go over very well either. That was the conversation I was having with my friend. So he didn't like the answer. Like he says, well, what's your general thesis? Like, we're not talking specifics. He's kind of in a different area of discipline than I am. More of a penny stock investor kind of thing. And so I said, he who loses the least wins. And he didn't like that answer. He goes, what do you mean there won't be any gains made?
Yeah.
And so I said, well, how do you define gains? And that's another thing I like to do in conversations that irritates people, is get them to define what they mean by things. Because in fact, if you presume what you mean by a gain, and everybody thinks they know what they mean by gains, but there's nominal gains and real gains. And I hear a lot of like higher level guys talk about nominal gains and real gains. And I'm sure the average investor that just goes in you just filter it out. It goes by and you go, yeah, I don't know what they mean by that. Real gains. What do you mean real gains? But this is really what I was trying to suggest to my friend, that there's a difference between real gains and nominal gains.
Interesting. Yeah.
So
explain the difference. Yeah.
Yeah, this is without a doubt one of the hardest things to explain to people. You almost have to come up with working models for it, which I plan to do, but then when you get into the planning phase of it, you find out it's again difficult to come up with an illustration for real gains versus nominal gains that people can understand and relate to, and not get the wrong perception on what the cause is, like what the actual causes are, because that goes even beyond that further. So right now, well, for example, I was talking to a group of people, and you remember that conversation, you were there, and the guy asked me, he was a Bitcoin guy. And I said, yeah, I got nothing against Bitcoin. Bitcoin's great, but right. It's a very, it's in flux right now. It's very volatile. It's very high, very low on a very short-term cycle, a couple, 3 years. And it's, reaching new peaks and new lows. And what was it, 70,000 at the time. And of course, anybody who held Bitcoin at the time it was 70,000 had their chest out and was pretty proud of themselves. But what is it at now? It's now below 30, and it was below 20 for a while since then. So my comment to him was, and it's along the same lines of perceived value. He said, well, his complaint was that silver and gold were very stable. They just, hadn't done anything in the last year. I said, right. But now, upon reflection, a year later, my answer to him was that it's an asset. I didn't get into too much detailed elaboration because it's not the context in front of a group of people to try to explain that. I have enough trouble explaining it here in an intimate video, much less in front of 200 people. So I just basically said it's an asset. And the fact that it's stable is an important feature, because if you look at the major asset classes right now, they've all gone down in the last year. Bitcoin's gone down, stocks, bonds, and real estate have all gone down, and so gold or silver being stable, well, you could now trade your gold for one of those assets and get more multiples of it in real value, right? Not numerically. The numbers only allow you to compare, so you can decide which is undervalued or overvalued. And that's the step that people aren't willing to do. They're not willing to compare things. In fact, I have a thesis that you actually need 3 data points in order to properly compare for value, and I'll eventually explain that. It's sort of like you need 3 points in space to know where you are, right? So you need that triangulation. I think it's the same in finance. I think you need 3 data points in order to decide if something is overvalued or undervalued. So without getting too far down that path, let me get back to answering my friend's question. So I said, he who loses the least wins, because we're going to be in a market where people are going to lose. Numerically, we're going to lose numbers. The houses numbers are going to get smaller. Stocks numbers are going to get smaller. The things they represent are still there, but the house is still the house. This house is still 2,500 square feet or whatever it is, but it's going to lose numerically. It's going to lose numbers. So the real value is the house itself, right? Which I joke and I say the real value of your house is one. Measured in houses. Measured in houses exactly the same as yours, your house's value is one. You have one of your house. That sounds absurd, but you say, well, what's your point? Well, if you say $700,000, now you've taken that house and chopped it up into little tiny increments that called dollars. And now you can take pieces of them and give them away or steal them, right? There's a little clue for you how we get robbed, right? We divide the single value objects and we divide them up into little increments called dollars and yuan and pesos, right? And then you can take a part of that property. You can't take a part of someone's property, like take a brick or a board off it or an eaves trough, but you can't take it unless you divide it up into little units and then that represent it, and then you can take some of them. So that's a clue to you that how numbers confuse the issue. You have one house. It could be measured in a number of different ways. It could be measured in dollars, pesos, oxen. There was a time when oxen was the main way of measuring things because everybody understood the value of an ox, right? So the numerical values of things are very tricky because we get hung up on that number and we think that number means something, and it does at the time, but it doesn't mean anything over time. Again, we can argue all day long about how currency loses value over time. Why it loses it just does, and we can debate all day about it. We may never come to the answer, but we can certainly see the results of it. Yeah. And so in a losing market, when most assets are losing, I prefer to be in the asset that's losing less, because when it's all said and done, back to my Bitcoin gold analogy, gold stayed stable, which seems like a negative when you're in Bitcoin, territory and it's going up, seems like a negative, but when things stabilize, suddenly it's not, right? So we got somebody here going to pause recording. So I guess one of the things that every time I get into like individual aspects of this conversation, it ends up being a holistic conversation about a number of things to try to get a better understanding of it. So at the end of the day, the hardest thing for people is the number. The number messes them up because the number is just a representation. And again, I'm down to words again. Take the word represent. What does it mean? Break it down into its represent. It presents alternatively or against something. It's acting in place of, or it's a surrogate for the real thing, the dollars. And the number is only relevant to what it can buy of another asset. When I really get into it with people and we banter back and forth and they're trying to understand it, we almost always have to bring in, the idea that if you only own one asset, then really this conversation is moot, because you're going to have that asset, you're going to give dollars for it, you're going to sell the asset and get dollars back, and hopefully you get a lot more. And in a case like that, yeah, you want to get a lot more. But if you're talking about the average household or the average person, what the message we need to understand is we need to own more than one asset. Most people's major asset is their home, which doesn't give them much flexibility. Everything around that home, has to be very official. You have to sign papers. You want to get some capital from your home, you got to talk to your bank or get a line of credit or all of that, right? That's a facet of that asset, which is restrictive. There's pluses and minuses to every asset. So owning multiple different assets gives you different dynamics and different options whenever there's an issue in your financial world. So if all you own is your house, it's going to be very hard to have a conversation with somebody like that if they don't own some stocks and bonds, maybe some Bitcoin and some precious metals. That would be a better asset mix so that you can play back and forth with those things during times when some of them are overvalued and undervalued. And this is something people don't consider. They think dollars in, dollars out. And that's a very limited way to look at it. So we need to talk more and more about this. Like, we could literally run a YouTube channel where this is all we talk about, I swear. And, over time, you slowly drag people kicking and screaming into the message and get them to understand it, I guess. It's talk
about how gold and silver are liquid, like, with the, you have 44 acres of land, but you can't really split it up and sell each acre at a time.
Very difficult, right? Yeah,
Yeah.
so if I had 44 ounces of gold or 44 acres of land,
Yeah.
you know, I've got two different dynamics. I may or may not be able to sell off an acre of that land if I wanted to, but I'm certainly going to have to ask permission and go through a process. But if I have 44
Regulations.
ounces of gold, I can sell an ounce of gold in 20 minutes if I'm close enough to a bullion dealer.
Yeah.
And so it's a different dynamic, right? Not that either of them are right or wrong, but we should certainly have, I see them as tools, like money is a tool. I see it as neither good or bad. You know, the money is the root of all evil thing, right? I see it as neutral. It's a tool. It can be used for bad and it can be used for good. So in this case, I mean, anything you do in your household to, you know, generally defend your asset mix is good. And that's a good use for that tool. And having different assets that we buy with our currency gives us a lot more options. And this is something nobody talks about. They just talk about price and, you know, buy low, sell high. Yeah, I get it. That is a factor, but it's a small factor in many cases, and it's not the only factor. And that's the big
Yeah.
takeaway from all this. Yeah, don't get hung up on price. It's it has its role, but it's a very small role, in fact.
Yeah.
Yeah. So I think that covers it for now. We could, like I say, we could talk all day. We should talk in little segments and people can digest it better.
Mm-hmm.
We'll leave it at that.
All right.
Take care. Have a great day, guys. Thanks for listening.